All right. So how do you, now you found the deal, you like it, you want to make the investment. First of all, you got to work with the title company. So it's pretty simple. It's usually the closer themselves or the closing assistant, and you want to send over all the figures. So if you're charging fees, you're charging interest, you got to get the appraiser paid, you got to get a survey, whoever needs to get paid and settled out in the closing, you need to make sure all of those numbers go to the closing statement or the closer so that they get on the closing statement. And then you want to approve that statement before you ever send the wire in. So that's really that's working with the title company. It's all about that closing statement or settlement statement. So I said here, approve that.
Yep.
Then you can wire in the money. Now, what we've done is we'll send in our loan documents with a closing letter or an instructions letter. And in that letter it says, you need to send us copies of the entire loan package and the closing package, and then hear back from us approval to release the funds before you ever release the wire. So we might send the wire in the day before or the morning of closing, but we're also sending in a document that they have to sign that says we are not releasing any funds until we get final approval from the lender. So that's been a fantastic improvement in our business we learn these things as we go, and I'm trying to teach you as much as I can in a short amount of time, but that's one of those things that I would highly recommend. And then finally get the loan documents together. So early on when I was getting started, I went to this website here. It's a singlefamily.fanniemae.com. And then you can see all the different loan documents that Fannie Mae provides. And this is all free. So we all like free, right? So this is going to have all 50 states, mortgages, deeds of trust that are approved and accurate for those specific states. And then also the promissory note. So really you could get away with those two documents, the promissory note and then your collateral, your deed of trust to your mortgage. And so you can go here and get all of this for free. Now I did that for maybe 25 or 30 loans. And then it was like, oh my gosh, I'm really starting to have success in this business. I really love this business. I want to do this. That's when I went out and hired an attorney, and then they drafted full loan docs for us. And we've had multiple attorneys go through our documents, and we've actually been challenged multiple times also by borrowers. Borrowers get so squirrely and funny when they don't pay you and then you actually enforce the note. So sometimes we'll get challenged, and so it's good because then we could see where there might be holes in our documents, and we'll have an attorney, well, we got to fix this section, or we got to add this in. Give you an example, John. One of the things we learned is on new construction project, I just assumed if I foreclosed on it, I would get all the intellectual property. So the intellectual property would be like the engineering, the soils reports, the architecture, all of that. And you need all that to build the house.
Right.
Well, that doesn't come with the foreclosure, right? That's personal property. It's not the real estate itself. So what we've started doing, because I learned the hard way, is we have the borrower sign an intellectual property assignment at closing. And it only goes into effect if there's a default on the loan. So if we accelerate the note, that assignment becomes in effect, and then now we own all of that property. So that's one of those things that you learn as you go. And that's not going to be in these documents. But I just wanted to provide a way that you can go get started at least without spending big money on an attorney. You could get away with a handful of deals likely on this, but maybe I shouldn't even say that. An attorney is definitely the way to go to get your loan documents. Okay. Then once you have you're approved, you made the investment, you worked with the title company, you sent in your wire. Now you own the loan. Your clients out there doing their fix and flip. What do you do to service the investment? So this is where we talked about it's not 100% passive if you're doing this on your own. It's mostly passive. But it's not 100%. So you do have to collect the payments. And I strongly encourage you to accept monthly payments. So pretty much every borrower will ask you, can you defer the payments? Can you just put this on the back? Because they don't want that monthly pressure. I would not recommend that. If you're forcing your borrower to make payments to you every single month, first of all, it helps with your cash flow, one. But two, you're going to know if there's a problem within a 30-day time, right? Because they're going to miss a payment. If there's trouble, and they're going to try to figure it out, right? They're going to try to dig themselves out of that trouble without telling you. So you won't even know until the very end. And that's when it's worse and worse. It just gets worse and worse. Right now, your loan size is getting bigger and bigger and bigger. If you're getting payments every month, you're keeping your loan to value consistent with what you agreed to. and it creates pressure. And pressure is good. Pressure helps your borrower move quickly, do a quality job, because they want to get out of that loan payment as quickly as possible. So a piece of advice here, always collect monthly payments. Monitoring the construction. So if you're providing, maybe even if you're not, but if you're providing construction money, you want to go out there and visit the property or have an inspector go out there and visit the property. There's lots of third-party inspection companies, title companies do this a lot. So you could hire someone to do it, but before you release draw money, go out and make sure that they actually did put in the windows or the roof is new. Maybe you want to see the permit cards. Like, do a little bit of work here to make sure that the project is progressing as they're telling you it's progressing. Handling defaults and slow pays. Defaults happen. Our default rate's 1.7%, which I'm super proud of.
Wow,
but
great.
look, it does happen sometimes. So you're going to see every once in a while a borrower go through a divorce or get in a car accident, or there's things outside of our control that we can't look for in our underwriting, and it could cause a default, and you need to stay on top of those. Oftentimes it's how do we help them get out of the situation, because we don't want the property back. It's much better if we could help them finish the project, if it's at all possible. But sometimes they just stick their head in the sand and they're not going to work with you, and you have to foreclose. But there's got to be a process here to handle defaults. Payoff statements and releases. This is actually pretty easy, but when they're getting ready to pay you your money back, they're going to call you up and say, hey, can I get a statement of payoffs, or a payoff statement? So it's got to say, this is the amount of the loan. This is all the late fees, whatever the fees are that hasn't been paid, any extension fees, all of that, plus any interest. I should say this. When I was starting out, I didn't do payment. I did payment in arrears. I've always done payment in arrears, which just means you pay for the interest after you've used it. So let's say what month we're in here, October. So if we're going to say October, interest isn't due until November 1st. Very, very common in the lending business. But what I would do is, if you close on October 25th, then your next payment is due, or your payment is due November 25th for that last 30 days, right? So I had all these weird payments. Like, I was having payments coming in every single day of the month. So what we ended up doing is paying in advance the first month. So if you close in October 25th, you might pay 5 or 6 days till the 31st for October's interest, and you pay that right now. And then we go to the arrears. So November interest will be due December 1st. So you won't have your first payment until December 1st for November, but at least that gets me on the first of the month for everybody. So everyone is due on the first.
Got it.
And the reason I bring that up is because when you do your payoff statements, if you're going in the arrears, which I would recommend, then you have to do your payment, your principal payment, plus any interest that they've used that hasn't been paid yet. So if you close today, October 25th, you might have 25 days of interest plus the principal amount. And that's what you would put on your payoff statement. And then the releases, you just got to release the lien. This is really simple, guys. And people sometimes get a bit nervous about this, but let the title company do it. The title company is the one that's insuring the new lender and the new buyer of the property. They need to make sure your lien is released. Otherwise, they can't offer that insurance. So the burden is on them. So I would say definitely make sure that they create the releases so you don't have to worry about it, and have them send it to you, and then you could just execute it. So there's no pressure here to not screw up a legal description or something like that. And then finally, the tax forms. So for us, we send 1099 tax forms to our lender clients or investor clients, and then all of our borrowers get the 1098. So this is an interest expense for our borrowers. The IRS does want this disclosed. So they want to know what income you received and what income they've paid you. So it's going to show up as income to you. It's going to be a deduction for them, and you have to send that to the IRS. So that's what the 1098 is.
So is that from a private, I guess the one-to-one private lender perspective? I'm having to deal with this year. Is it a pretty simple form to fill out, or do we have to get a CPA to actually develop and generate that form for us to send to the borrower?
So that's a great question. I've never actually filled out one by hand. So early on, my CPA just did it all. They're pretty simple for them. It's all in my books. And it was all in like QuickBooks and spreadsheets and all that.
Yeah.
Once you start using loan servicing software, which once you're doing a handful a month, you're going to want, then the software does it. It just prints it out and just mail it in.
Got it. Okay.
But for you, John, I would say probably ask your CPA to help you with that, because I don't know the best way to handle it.
Yeah, that makes sense. And then secondarily, the slow pays. So when do you I mean, I think you'll have it in your contract that you miss a payment after a certain number of days, then after the due date, then you will start charging interest. Would that be accrued on the next period? And then what if they eventually just miss that? At what point do you kind of initiate that foreclosure process versus allowing more slippage? And is it a slippage hit?
All of this is all great questions. So I'm going to tell you the process, then I'll tell you how we vary from that.
Yep.
So we have a grace period of 5 days. So it's due on the 1st, it's late on the 2nd, but you don't get a late fee until the 5th. That's when the fee hits. Now, it is super rare. Under 1% of the time, we waive that late fee. So it's going to get charged. Now we'll just add it to the loan. So late fee on the 5th. Now, the 15th of the month, if we haven't received payment, we're going to send the demand. That's basically the start of the foreclosure. So that says you have 30 days to pay off this loan 100%, or we're going to start the foreclosure process. And then after that demand expires, we send it to the attorney and then let them handle it. Now, when we vary from that, so let's say we're actually communicating with the client and they're just getting into a little bit of a tough time. Maybe they had some extra expenses come up and they had to spend a little bit more on the property instead of pay us, or whatever the excuse is, right? But they're communicating. Well, we're still going to charge the late fee. We're still going to send the demand notice, but we won't send it to the attorney necessarily unless we can't get them paying or some kind of payment arrangement. We're still going to send the demand because we're very serious about this. And that at least gives us the opportunity to start the foreclosure if communication stops, if they don't do what they say they're going to do, any of those things. But look, if you're in trouble and you're communicating and you're working with us and you're being honest, then we're going to do what we can to help you.
Okay. Very good.
We're just not going to not send the demand can expire and you could not send it to the attorney and start the foreclosure. Maybe it's another month you give them, but at least now I have the ability to start it immediately at any time.
Yep. Perfect.
All right. So let's talk about where you find the money. So you decide you want to do this business. You love the stability of it. You love the security. You love the cash flow. You love the high returns. You love all the stuff that I love about it. Where do you find the money? So if you have the cash, that's the easiest way, right? You have the money. It's easy. What about your IRAs and 401k? So there's several different things here. There's a self-directed IRA, and I was almost going to say obviously, but it's not so obvious to everybody. There are IRA custodians out there that allow you to invest in real estate and private notes and equities, like private companies and all of this kind of things. But it's not your Charles Schwab's. It's not your Fidelities. Right? These are true self-directed administrators. They don't sell investments at all. They just help administer the investments. So if you have money in an IRA or a 401k or SEP or even an HSA, a health savings account, any of those types of accounts that are there's tax deferment or tax benefits, you could roll those into a self-directed account and invest in this stuff. So you would literally have to take it out of your current administrator and move it on. With that, so that we see, I'd say 30-ish% of our investors are IRA investors. 401ks, you could do the self-directed also, but you cannot do that if you're still employed with a company with your 401k. You can't move that money out until there's a separation, but you could potentially borrow from your 401k. So we do see this: borrow from your personal 401k, make a loan to your buddy or someone you met at the RIA, and pay yourself interest and keep the spread.
Right.
So that is possible to do it that way also. You could also borrow from somebody else's IRA and potentially bring in some capital that way. And I'd be a little careful there, because if you're starting to bring in money from other people or other IRAs, you might be getting into some securities laws. So check with your attorney, but there's some options there. And I even put here other people. So this is exactly, John, how I got started in this business. And it's interesting because your name's John, because my first investor's name was John and he had $100,000. So that example that I gave you was my true real life first investment example. So I brought those two, and I brought John and the other investor, her name was Pat. I brought them together, charged $4,000 in origination. I gave $2 to John. I kept $2. So that was my very first transaction back in 2006. But since then, now we have about $140 million in our different mortgage funds and our private note buyers, all private people, 140 million. So that's exactly my business. I bring in money from other investors and I use that to make these hard money loans. So one word of caution, and I know we don't have a lot of time, so I can't really tell you the whole story, but I did get a call from the state of Colorado because I was doing this incorrectly, and they take this very seriously. So I got invited in to their office. I had to go through everything that I was doing because I was doing it without a securities license. So now I'm licensed, I'm bonded. I got all the stuff that you need to do this correctly and successfully. But if you're just doing a couple, talk to your attorney, just doing a couple, you're probably okay. But if you're looking to turn this into a business like I did, you're probably going to need some type of licensing. And then finally, you could borrow. So this is exactly what banks do, right? Banks take your money in, pay you a percent on it. Maybe now, it used to be like a fraction, right? Like 0.01%. Now we're seeing returns a little bit better in the banks, but let's say it's a 1% for a checking account or something. They take your money in, pay you 1%, and then they loan it back to you in a car loan at 8 or 9%. Right? That's how banks make money. And it's just a spread. So I put in here this little example, and I don't know that I would necessarily recommend doing this with a spread of only 3%, but let's say you could borrow at 7. That's like close to what you would borrow if you were borrowing on like a primary home. And then you could lend at 10. That's a very conservative low end in the note business. I was curious, actually, John, you said you do some lending. What are you guys charging?
So it's interesting because it was for I think a 3 or 4 month project. And it was essentially on the order of 20%, 20+%. And my borrowing rate, because I did exactly what you're suggesting here, I borrowed against my HELOC, which at the time was very, very low, was about 4 or 5%. Now it's about 7%. So it's still a decent spread, but and it was about that same loan amount, like about 200K. So
that's a fantastic deal.
Yeah. So it was fantastic. Now that interest rates are going up, it's still a great deal, but it's becoming less and less a good deal. So
yeah, I would do that 10 out of 10 times. So
yeah,
but if you're only getting 10%, which is on the low end but pretty common, you'll see it's not as good, but you're still pretty good.
Yep.
So in my example here, income at 12 or at 10% is almost $1,700 a month. So that's the income coming into your pocket. But then you got to pay that HELOC or your mortgage. So at a 7%, you're paying $1,166. So your spread on this one deal, roughly $500 per month, every single month. And it's zero of your own money, right? All you're doing is arbitrage. You're creating that spread. Yep. So again, $500, is it worth that extra risk? I don't know. It's something you would have to look at yourself. But when you see rates go back down, when this spread gets to 4, 5, 6%, these numbers become very, very attractive. So just keep in mind that borrowing money to lend it out carries additional risk, and it can create some huge income without any of your own money.
Yep.
Okay, the differences between a fund and investing in single notes. So everything we've talked about today, John, has been individual notes, right? You're going to make one loan to one borrower to do a fix and flip in most examples, but there's different funds or pools, we call them, that you can invest in also. So every single pool is going to be different. I'm going to go through like how we structured ours, just because that's the one I understand. But if you Google hard money lending fund. You'll see lots of them out there that you could choose from, and they all have differences, right? And some good, some not so good. But here is just comparing a single note to a pool. So some advantages on a single note, you have a higher return than you would get in a fund. That's almost always going to be true. Just like you were getting such a high return on your individual note, you would not see that in a fund. You may end up getting the property. So we call it loan to own. I know it's got a terrible name. I hate it. But if you want a property, and as long as you're being conservative on your lending, this could potentially be a way to acquire a property. If they default, that's what happens. If they default on your loan, you get the property. And it's secured by one property. So, oh gosh, have you heard of the guy named, what was his name? Bernie Madoff, something like that. Yeah. Yeah. So we've all heard of this, right? We've all heard of the Ponzi schemes. So if that is a concern, then the single notes is 100% the way to go, because it's very transparent. In fact, there's no investment out there, no commodity out there that's more transparent. I could literally pull from my phone. I could get on here and I could look up like every property that you own and what you owe on it. Right? It's because it's all recorded with the counties. So that gives investors comfort for sure. So advantages of a pool, very consistent. So if you're doing individual notes like you did, when that pays off, then you go from 20% return down to 0, right? And then you got to go out and find another one. So that creates a little bit of a volatility. Diversified over several properties. So if one does go bad, like yours, if they stop making payments, you're probably very well secured, I'm sure, but your income is going to stop until you can deal with that problem. So diversified over a lot of properties. If one goes bad, it's not the end of the world. You're still going to see the monthly payments coming in. It's truly passive and liquid. You don't have to worry about anything. You'll never get a house, and you never deal with the tantrums. You never deal with the tenants, the toilets, the tantrums. Borrowers, foreclosures, missed payments. You don't have to deal with any of that in a pool. So definitely some huge advantages to a pool. It's the transparency. That's really the one piece that's missing if that's a concern. Disadvantages of a single note. The excess cash. So you said 200,000 and you use a line of credit, so that's perfect. There's no excess cash. But let's say you had $200,000 in cash, not debt, not a line of credit, sitting in the bank. You want to find something to do with it. And you find a borrower that wants to maybe borrow $180,000 from you. Well, great. You have 200, so you can make that loan. So you make the loan. So now you're earning your 10, 12% on the 180 grand, but then you have that extra $20,000 that's sitting in the bank earning the 1 or 2 or whatever it is. So that brings your return for the full amount, the full 200 down, right? Mm-hmm. Mm-hmm. Time between deals. We just touched on that. When your deal pays off, you might have a month or 2 lag before you find another one. Now, again, on the line of credit, it's not such a big deal because you just use that money to pay off your line of credit. So you're not sitting on cash earning no money. But again, if you have cash and you have that lag, that could bring the returns down on an annual basis. You may end up with a property. So it could be a good thing or a bad thing, right? So let's say somebody decides to cook meth in a property. And now you end up with that. That could be a big, big problem. You do not want that one back. Not liquid. There's no market for these notes. And I get pushback on this one, John, to be honest with you. People say, well, you sell notes, so there's a market for it. Well, I created that. I have investors that call me wanting loans because of what I was able to create. I can't just go out and sell notes in the open market. At least not unless I'm willing to accept a discount. And it sounds crazy, but let's say I have a 12% note and it's $100,000 par value, and I'm trying to sell a performing 12% note in the open market. People will offer me less than $100,000. They'll demand a discount, even though it's a high interest rate performing note. So I say it's not liquid because you better be expected to take a loss on that if you need to sell it.
Which is funny.
And your payments could.
I was going to say it's what banks do. That's the CMBS, right? It's like banks do this.
Oh yeah.
But personally, where like as an individual investor, you can't do that. It's interesting.
Yeah, well, because again, they've created those relationships.
That's right.
So, and we're just now starting to talk to family offices and institutions that want tranches, 5 to 10 million tranches of loans. So now we're creating that way to offload. But again, we're demanding par value. we're going to give you a high interest rate, high quality performing note. It's par value or it's nothing.
Yeah.
All right. Disadvantages of a pool. You will not look at each individual deal. So if you're a deal guy and you want a guy or gal and you want to see the details, you want to see the financial statements, the credit reports, the appraisals, then you definitely want to be in the single notes, not the pools, because you're not going to look at that. This is like a mutual fund, right? You're not making decisions on what the investment's going into in a mutual fund. They're just out there trading stocks on your behalf. It's very similar. Slightly lower return. Although I would push back on that one. I think on an annualized basis, you might see a pool higher because you don't have the excess cash issue or the time between deals issue. And you would never get a property back in a pool. The pool manager, if there's a problem, they take the property back, they handle that problem. They'll disclose it to you, so you'll definitely see that, but it won't have a big impact on you. Okay, now I've said multiple times in this webinar about the consistency and the stability. So I just want to show this quick graph because I think it's kind of funny. This is the last like 20 years of the S&P. This is the S&P 500. And you can see great returns, right, in the 20s. But you could see like 2008, right, huge 40% loss. And it's just all over the place. And the interesting thing about, in fact, let me show you on the next slide. The interesting thing is when you see a loss, so this is the S&P versus an 8% fund. If you invested $100,000 and you reinvested the money in the fund, or if you just kept the money in the S&P. The interesting thing is, so you have a value of a $100,000 investment that went up to, what is this, maybe 170, I'm guessing here, but looks like maybe close to 170. And then there's a drop. This would be 2008. And so it went back, basically you went back to your original investment. So for a 7-ish year investment, now you're basically even, right? You haven't made anything.
Right.
But look how long it takes. I don't know if can you even see my mouse, John?
I can, yes.
You can, great. Okay. So how long until you get back to about the 170 where your peak was? So now you're in almost year, look at this, maybe year 12?
11, 12, yep.
11 and a half, 12, something like that. So you're looking at 5-6 years of good returns to get back to even, just to get back to where you started. Right? That's how devastating a loss is in investments. Because if you think about it, if you lose 10% on a $100,000 investment, you lose $10,000. So now you're down to 90. Well, if you make your 10% back, now you're only at 99. You make 9,000 on that 90. 10% return on 90 is only 9, right? So now even the 10% gain after 10% loss doesn't get you back to even. It has to be higher than that to get back to even. So that's what these losses in the S&P, why it slows your growth down so significantly. But I mean, it's actually not so bad when you look at it over the long term. They're almost, I mean, they're kind of the same, but it's just without the volatility.
Yep.
But gosh, look at this long stretch here after 2008 before stocks popped back over what the fund would have done. And then now we're back down again. So just some interesting slides on how slow and steady, tortoise and the hare, right? The slow and steady wins the race. So you don't need to chase those super high returns and absorb losses doing it. If you're confident in the gain and the consistency, you'll win the race. So that's all I have. No, I have this little bonus section. Do I have time? I think I'm going late, aren't I?
Yeah, you're going late, but I love the material. Go for it. As long as you
okay, I'll go quick here. I'll just throw them all up. So the top mistakes that I see investors make, and John, I'm not kidding you. I get calls at least one a week from investors saying, hey, I just did this and how can I fix it? Right. Well, sometimes it's not so easy to fix when you make a mistake. It's much better, obviously, if you don't make that mistake. So here's some of the top mistakes that I see private lenders making. Investing in a junior position. This is hands down number one, because there's a lot of national gurus out there teaching this. They call it gap funding. So borrow as much as you can from your hard money lender, and they're going to stop at 65 or 70% of the value, but you need another 10% to get the deal done. So go out and find another lender and fill that gap. Okay? And then maybe you could pay a higher return because it's a second position. It's a junior position. So you pay a higher return to that investor, and then that's going to get them excited. And then you could sell it to them because you're still secured by the real estate. Well, the problem, John, is you're not secured by the real estate, because if you're in a junior position, in order to get access to that real estate, You need to pay off any lien position in front of you. So if they foreclose and they take the property, you have a period of time, it's called a redemption period, where you can get the property, but you have to pay off the senior lien, the senior debtors. And that includes their principal, that includes their interest at the default interest rate, which every lender has a default rate. It's between 18 and 24%. So and that's going to accrue all the way through until the foreclosure is done, plus attorney's fees and late fees. So it's significant. And if you can't pay it off, then you don't have any collateral at all. So really, you think you're investing in a loan that's secured by real estate, and you don't have any collateral at all. Fractionalized notes. This is becoming more and more common. This is when I say, let's say I have $1 million loan and I'm going to sell it to 10 different investors for $100,000 a piece. So I could break up my $1 million loan and sell chunks of it to different investors. It's actually kind of cool, and it helps create some diversification, as long as the sponsor is responsible and can handle a problem. Because if there's a problem on a fractionalized note and there's nobody there to drive the ship, then it becomes a bigger problem. Property valuations, we see problems with that all the time. Here's the thing. They don't teach property valuations in real estate school, at least not in Colorado. I find very few, and this is going to offend some people, and I'm going to apologize in advance, but I'm going to say it anyway. A lot of realtors and real estate agents don't understand how to value property. And they're out there giving advice to their clients, but they've never been through the training, right? That's what real estate appraisers are. So I'd say just be careful on getting your property valuations correctly, and don't always take advice from people who haven't learned how to do that. Improper insurance, we talked about that one already. And then servicing, making mistakes in servicing, not forcing monthly payments, not sending that demand notice, believing the checks in the mail excuses, not going out there and making sure that the project is progressing as it should. And if there's problems with the construction, addressing those problems early. Those are some of the top mistakes we see. And then finally, if you are interested in private lending, whether we work together or not, I'm fine either way. I want you to do what's best for you and your family and your investment portfolio, but please be safe. So we wrote this report because I get calls every single week, how to get myself out of a jam. So we wrote this report, and we'll provide it to anybody who wants it for free. That's thepinereport.com. And if you have any questions, let me know.
I did have a few questions I think our readers or listeners might be interested in. So how much time do you spend raising funds versus lending? Can you talk a little bit about that?
Yeah, that's a fantastic question. So the majority of the time is lending. See, it's hard for me to answer that because of where we are right now. So I have a team of 13 people. And we have 4 loan officers and myself. I do still originate loans. So I have a small book of business and clients that I just love, right? We become friends. And so I keep those. And then plus the 4 loan officers. We have 1 person plus myself raising money. So we spend a lot more energy in the loaning out because I could recycle the money over and over and over and over. But we're still raising $1.5 to $2 million a month in fresh capital coming in because we're growing. So when I was getting started, though, it's, hey, I've got an investor that has $100,000. It's John. His name is John, and John wants to loan that out. So now I got to go out and find my client. So I would spend more time on that side. So.
Got it. Perfect. So real estate investing, and then in the either construction or even the residential side, there's a lot of write-offs, depreciation, or accelerated depreciation. Could you talk a little bit about tax incentives from that perspective? Any incentives from a taxable perspective?
Yeah. So there's not going to be any in the private lending business unless you're taking equity. So if you're, and that would be different than what I was talking about earlier when you're securing a partnership with a lien. If they're signing a note and you're putting a lien on the property, that's a lender. So that you're not going to own a piece of the property, so you don't get the tax benefits there. Now, when you start talking about accelerated appreciation, that's very common in the commercial world. You'll get a cost, they call it cost segregation. There are different terms for it, but mostly it's cost segregation study, and they'll put a value on every little piece of whatever in the property, and then you could depreciate different items at different rates. So like personal property, for example, let's say we're talking about a house and you want to depreciate carpet, that might depreciate over a 5-year period, but the structure itself is over 27 and a half, right? So you could speed up the depreciation and get much larger tax benefits early on in ownership. I hope that answers your question, but again, that's for ownership, the active investor, not the passive investor.
Yep. You talked a little bit about your criteria. How much, and being in the built-to-rent construction world, we do a lot of underwriting across the different phases. How much underwriting do you do of any of the opportunities that come your way, or do you primarily look at the list of assets, the list of paperwork that you outlined in your presentation?
Yeah, so that is the underwriting, that paperwork. Now, the commercial side is a bit more complicated. We have checklists for everything, right? So we say, okay, here's our underwriting checklist, here's our processing checklist. So processor, you got to collect all of these things. So it might be a environmental study, it might be the soils report, like I mentioned on the new construction. It might be the architecturals or the city approval or what you like, collect everything, and then our underwriter is going to go through and review it all. So part of the review process is, do the ratios make sense? I mean, is the value, do we look at the value and do we agree with the value? We'll cut appraisal values occasionally because we've seen things like busy roads have big impacts on values. And so I'm pretty conservative when I see a house back to a busy road or front a busy road, even worse. And that sometimes the appraiser has no data to make an adjustment for that busy road because they haven't seen any other property on that busy road sell. So they don't really know what the impact is going to be. So they might say, well, I'm only going to give it a 2% or 3% hit to value because of this busy road. But that busy road might be a 10 or 15% hit. And that's what I've seen over 20 years of doing this. So we'll say, Mr. Appraiser or Mrs. Appraiser, I appreciate you doing this report. We're going to cut the value by another 5% because we don't have any data to support the adjustment you made for this busy road. Yeah. I mean, that's an example. So we'll do things like that during the underwriting. I have an underwriter now, so I don't underwrite as many. Up till maybe 4 years ago, I looked at every single deal that came through the office.
Yeah, that's great. One last question for you, which is, people in our audience are either investors themselves or they may be looking into private lending. So how can you help them in your organization? If they have money, can they invest with Pine Financial Group? And then if they're interested in getting into private lending, what can they do?
Yeah, so I think the first step is to download the report. So go there for sure. Even if you're not wanting to be a private lender and you're more on the active, you're a real estate investor side, it's still great information. But this report is definitely geared to the passive investor. So someone who wants to lend money out. Now, what can we do to help them? Yeah, we have mortgage funds that we accept investors in, and occasionally we sell loans to individual investors. So that would all start with a phone conversation, getting to know each other a little bit better, and just making sure it's a good fit. Right. And the cool thing about our fund is it's liquid. So if there's any discomfort on either side, we just separate. Right. You don't like the reporting, which I've never heard that before. But let's say someone doesn't like how we report or how we communicate, then they could just say, well, I don't want to be a part of it. Let me give my money back. And we do that.
Yeah, that's great. Well, that's a lot of great information you've provided today, Kevin. A great presentation. To learn more about investing in private lending, feel free to reach out to Kevin at pinefinancialgroup.com or simply navigate to that report on www.thepinereport.com. We'll include the contact information in the description for this podcast or webcast episode as well. And again, thank you for all the great information and taking the time out of your busy schedule to speak to our audience. Don't forget to like and subscribe to the podcast or whichever platform you're listening to make sure that we can continue bringing you the best educational content. Thank you, everyone. Until next time, keep learning to invest for generational wealth. Thanks, everyone.
Thank you, John.